It seems so hard to order. Who can I trust, and how do I even start?
Oh, you just go to sdbullion.com/rp, pick out whatever gold or silver you want, add it to your cart, you can check out, and it's on its way. And they're A+ rated by the Better Business Bureau.
Wow, it's that easy?
Your first ounce of silver is at spot price, and you get free shipping on any order over $99 at sdbullion.com/rp.
As a responsible person with growing concerns for your privacy and personal liberty, you want to know where we're headed and what you can do about it. We ask the experts what you need to do to take prudent and responsible action to safeguard your family's wealth and well-being, and what basic first steps will help you to be aware and prepared. ReluctantPreppers.com.
Reluctant Preppers provides educational awareness and commentary only. Opinions expressed do not constitute personalized financial advice. Viewers are encouraged to do their own research and seek qualified personal financial consultation before making investment decisions. Welcome back, Reluctant Preppers. We have a returning guest who our viewers are always eager to hear from. This is John Rubino calling us from the dollarcollapse.com. John, thanks for joining us again here on Reluctant Preppers.
Hey, Donegan. It's good to talk to you again.
It's been about 5 months since we had you on, never often enough for my or our viewers' tastes, but we're glad to have you and wondered if you could weigh in on some significant shifts that we're seeing in market behavior. We've had quite interesting last year or so, and even in the last month here, a sharp increase in choppy seas that a lot of people keep wondering, is this it? Is this the beginning of it? And if you've written some articles recently, including one about funds that are changing the behavior of the market by how they feed on volatility and drive it with their algorithms and so on. So if we could start off with that aspect of what's new and different in the markets from the past, and maybe some things that are resurfacing that we've seen before.
Well, there are a lot of volatility-related funds out there. In other words, so you could be a money manager who allocates between stocks and bonds based on the VIX. In other words, how volatile the market is. If it's not volatile, you buy a lot of stocks, and vice versa. And so, in other words, you're trading volatility, basically. And usually the way they do it is with a black box algorithm. You know, they just set up some parameters, and then the computer decides what the asset allocation percentages end up being. Now, this is, it's just one more black box trading program, right? But it's kind of like a casino adding a new kind of roulette wheel or something like that. It doesn't benefit society in any way, but it, in the end, probably increases market volatility because when all of these black box systems start moving in the same direction, you get extreme volatility. And that's a lot of the time that's what happens because they're all looking at more or less the same thing, or a lot of them are looking at more or less the same thing. And so they tend to move in the same direction. And the same thing with index mutual funds and ETFs. Those are funds that hold a basket of stocks or bonds or whatever that correspond to an index or some other category. And when they go up, lots of people pour money into them, and they have to go out and buy more stocks in that index. And when they go down, people pull money out, and they have to sell. So you get a self-reinforcing feedback loop that pushes the market in one direction or the other. And since we're way up in just about every category of every part of the stock market, the next feedback loop is going to be negative. And a lot of people are worried about what that means because we've had crashes in the past that were computer generated and driven by algorithmic trading. But we've never had this much concentration in the market in funds that are controlled by algorithms. So the next time around, it could be a lot worse than the times in the past. And, we've had some big program trading collapses in the past. In 1987, we had a 30% drop in the stock market, which is a huge drop for an index, in the space of a few weeks because of program trading. And now we've created the conditions for an even bigger drop or something more tumultuous in some way. So whenever you see a 600-point down day in the Dow, you got to wonder how much of that is driven by these algorithms, which feed back on themselves so that a drop leads to a bigger drop. And we're in a position where something like that is completely possible and can easily get out of hand. And that's something that anybody who's long stocks now has to be aware of.
in the fourth quarter of last year, we saw actually, let me go back, maybe actually a year behind. So over a year ago, in the fourth quarter of 2017, we saw like the worst December on record. And then the first quarter of 2018 was like the best quarter on record. And then it's just been so choppy up and down since then. It seems that the old adage of people being afraid to be caught in or being afraid to be left out might be at play. But you're saying that the actual, by design, the very nature of some of these volatility hedging funds is basically amplifying or exacerbating those the potential of those swings.
Well, that's the fear, because they act in ways that make market movements more exaggerated, and it's not clear what stops them other than them hitting 0% equities or something like that, and all bonds, which I guess is a limiting factor with that particular kind of trading algorithm. But there are other algorithms that don't necessarily have that limiting factor. And when you get 3 or 4 different categories of them all moving at the same time in the same direction, you get these big exaggerated market moves. And Dunnigan, I think it was just last year what you were talking about in December of last year, stocks tanked. We had kind of an instant bear market where just in the space of a couple of months, they dropped by 20%. And then the Fed came in and said, by the way, this is the next stage of this story, the next chapter of this story, is when these black box trading systems cause a crash, the Fed steps in with lower interest rates. And so they stepped in this time and said, okay, we're not going to raise interest rates anymore. Even though we told you 4 more raises in 2019, now it's 0, and we might even cut rates. And that lit a fire under the stock market, and we had this amazing January and February. And it's continued through to last week, really, before things got choppy again. So this kind of volatility is normal at market peaks, because when you get up to the point where valuations are really extreme, then you get a lot of people with a rationale for selling, but a lot of people with a rationale for buying, because buy the dip has been a brilliant strategy for a long, long time. So you don't wash that attitude out of the market with just a garden variety 10 or 15 or 20% drop. You need something more serious than that. Or people keep coming back in expecting it to turn around. So you get the kind of volatility at toppy markets where that seems really extreme, but it's just basically these two big forces playing out where people are looking at valuations and saying, I'm taking some money off the table, and other people saying, well, cool, I'll buy this dip, and you got billions and billions of dollars on either side or on both sides of that argument. So it goes on like this until one side wins the argument. And at market tops, it's usually the bearish side, right? The people who say, okay, I'm taking money off the table, and the market goes down. Then they say, okay, I'm taking more money off the table, and the market goes down some more. And then they say, all right, I'm cutting my losses now.
I'm going to cash out all my chips.
I'm cashing in everything. Sell whatever the price is, I don't care. And that's where you get capitulation at the bottom. So right now we're at the very top, the beginning of the process. Assuming that this is the top, you never know, because the central banks of the world are starting to ease preemptively. They know that an actual equities bear market in a world this highly leveraged can metastasize. Just in the past, stocks would drop, and that didn't really affect the rest of the world all that much. You might get a mild recession out of it, but that's basically it. Now, if stocks drop the way they did in, say, 2008, 2009, or 2000, you have the real risk of the turmoil in the stock market spreading to the bond market and to emerging market securities and to pretty much everything else you can think of. And then you get something that's like 2008, 2009, but with no way to stop it. You get something more, Great Depression-y coming our way. And central banks will clearly jump in to try to stop this, but it's not clear what they can do with rates as low as they are now, because we have no ammo in the central bank world. They're the European Central Bank and the Japanese Central Bank are at negative interest rate levels still, 10 years into an expansion. In the U.S., our short-term rates are like, 2.5% now? And normally they cut 5 percentage points between peak and trough in a cycle. So if they try to cut 5 percentage points from short-term interest rates now, we're at negative 2.5%. And anybody who tells you they know what the result of that would be is just delusional, because we've never been there before. And we've never tried anything like this, and we will almost certainly try it in the next downturn. And the guys running central banks know enough economic history, although their theory is deeply flawed, but their history, it probably allows them to know that they're in uncharted territory. And they're going to do what they've done. They're going to pull out that same tool, super easy money, but they don't know for sure what the result will be, because they're assuming at some point they have to stop, that interest rates can't go any lower. And the problem is they don't know what that lower limit is. There used to be something called the zero bound, in other words, zero interest rates, which economists said rates can't go below because it makes no sense. I mean, the interest rate is the price of money. And if you make the price of money negative, in other words, if you have to pay to lend money to people, why would anybody ever do it? So the economy or the financial system would just grind to a halt in that theory. Now, that turned out not to be completely true in Europe and Japan. So zero isn't the boundary. That's not the brick wall that we hit when we continue to lower interest rates, but we all assume it's out there somewhere. Economists expect that at some point interest rates get low enough so that they cause more harm than good. And we don't know where that is. And my guess is that it's not much below zero. If you get to 2 or 3% negative interest rates, you distort the financial system in some really fundamental ways. But we don't know that for a fact. And the guys running the central banks of the world know they're going to have to try it, because that's their only tool. If the economy starts to turn over now and they're at zero interest rates, in other words, if the economy can't grow with zero short-term interest rates, when money is free, and the central bank is going to make it even cheaper on the assumption that will make the economy grow and stop shrinking and go back to normal, that's a big assumption. And they know it's a big assumption. They know it might not be true. It's possible that at 2%, negative 2% interest rates, the whole thing just goes haywire. And then they have to make cash illegal, and they have to do some other crazy things that they don't know the result of. So they're in a pretty big box.
Yeah,
right now.
I want to get into some of those knock-on outcomes of negative interest rates in 1 second. But just on that point of, you mentioned it before, it doesn't make classical business sense, for example, for a bank that's actually operating as a standalone business entity with a profit and loss and balance sheet and everything to say, yeah, I'm going to pay people to borrow money from me. So does that mean that it's that those days are gone, and that banks are operating just as an arm of policy of the government now, and that we've had people talking both ways about this. Some people say it's the banks running the government. Some people say it's the government, the central banks running all the other banks. But does that mean that basically there would have to be this debt funding for? In other words, yes, it's going to cost tremendous amounts of lost money to fund this, better than free money at negative interest rates, but that just gets tacked onto the debt on top of that. How does that get funded?
Well, I think the answer is we don't know. Nobody knows how this is going to play out. They're already just experimenting and trying stuff and see what happens. And this is going to be a bigger version of that, because we really don't know how does the banking system work with negative interest rates. We don't know that. You can't even really model it, because it comes down to human behavior. It comes down to emotion. What do savers think? How do they feel if they're paying the bank to store their money? Now, there are instances in the financial world where you pay somebody to store your wealth, right? If you have gold, you pay a percentage point a year.
Because they're guarding something physical for you.
Yeah. But with something that's essentially digital.
Yeah. What am I paying for?
What are you getting? And what's the advantage over just taking it out in cash and hiding that cash somewhere in your house?
Right, and I still want to follow up on that question. But I remember when we bought our previous car 6 years ago. No, it was 8 years ago we bought a car, and that was at 2.5% interest rate, and then they came out with this 0% interest rate 6 years ago. We thought, well, shoot, we turned in our old car and got a new one, and with a little adjustment in the term, we're able to pay less per month and have a new car and all this. I thought to myself out loud, what are they going to do next time? I mean, we're already at zero. What are they going to do if the economy goes on longer? So would it be that consumers are actually going to feel told, will pay you to borrow money to, I mean, the bank said, we'll pay you to borrow money to go buy your next major purchase, or your car, or your house, whatever it is?
Well, that's what negative interest rates mean, basically, that if you're going to borrow money, see, we've been talking about saving money and what it means to have to pay to save. But the other side of that equation is that if you want to borrow money, you don't just get it for free. They pay you to do it. And that works for governments too. For instance, the Japanese government's deficit goes down the more short-term money it borrows, because it borrows at a negative interest rate, which means people pay it for the privilege of lending to it, which means their deficit goes down. And if you borrow a car and it's a negative 2% interest rate, your loan shrinks in value. It gets smaller over time beyond the principal you're paying back. It shrinks via the interest rate as well as the principal. Mm-hmm. So it's a great deal for people who think they can pay back those loans. And the theory is that it'll ignite a burst of borrowing because it's better than free. You know, you're getting paid to borrow money, and that the money that is thus borrowed will be spent, and that'll speed up economic growth. But it's not clear that will work that way. For one thing, well, actually, this kind of adds to the impetus to borrow. If you're in a negative interest rate world because governments are creating huge amounts of new currency, which they basically have to fund negative interest rates.
Okay.
You know, they've really got to buy a lot of financial assets in order to push interest rates down. They've got to do that with newly created currency. That makes the currency less valuable.
Okay, I was wondering where that's one example. That's one answer is where the money's going to come from. It's going to come from stealing it from everybody who has money. Okay, got it.
Which makes it even more interesting to borrow, right? Because you're getting paid to borrow and you're paying back your principal in depreciating currency. So in theory, that would ignite a burst of borrowing. But here's where the whole inflating away your debt idea breaks down. Because you're encouraging people to borrow really aggressively, the amount of debt in the system goes up faster than the real debt shrinks via inflation.
Right.
So you make the problem worse. And that's what we've been doing since the 1980s. We take on huge amounts of debt. We have a nasty recession, and we create a lot of new currency to cover the bad debt that was created in the recession. That leads to more borrowing, which gives us an even bigger debt load. Now we've reached the point where, if you'd gone back and asked economists 20 years ago if we could carry the current debt load in the global financial system, they would have said, no way, that's impossible. But we've got that kind of a debt load now. So the question is, are we going to double our debt in order to buy ourselves out of the next recession? And what does that mean? It already means, based on today's debt, that we can never raise interest rates again, right? Because we tried to raise interest rates in 2018, and the stock market collapsed at year end. So that's what made the Fed and the other central banks back off any hint of tightening, because they found out they can't do it. And they can cut again, in theory, but if they cut again, then they can never raise interest rates from those levels,
right?
Because we've taken on so much more debt. So now we're stuck with negative 2% inflation, interest rates forever. And what does that mean? See, nobody knows the answers to these questions. And it's a safe bet that the answers are pretty horrendous when we find out what they are, but we don't know for a fact specifically what they are. I think it's safe to say that volatility is the one guaranteed result from all of this stuff. We'll see chaos in the financial markets, but we don't know the form that it'll take.
How about the impact on cash? Because we've skirted around that a couple of times here. People who are either holding physical cash or have a savings account with cash, what effects have on that, both from a direct effect from the negative interest rate policies, but also probably a policy effect that they would maybe, if they go with further restrictions on cash, what does that do to people's freedoms and their ability to protect themselves?
Well, again, in theory, because we've never tested any of this stuff, so we don't know for sure, but it's true if it's true. But in theory, you can't have negative interest rates and freely circulating cash, because everybody would just pull their cash out of the bank, right? You'll store it rather than pay the bank 2% a year to store your cash for you. And if the banks are emptied of deposits, then that disrupts the banking system to an extent. And governments are already planning for that by deciding what and how and when to basically ban cash. They've got a lot of different ideas for how to do that. They could issue cash that depreciates along a preset schedule. In other words, if you get your cash and you spend it this week, it's worth 100%. If you wait 6 months, it's only worth 80% of the original face value, and so on, to force you to spend your cash. So you can't just pull it out of the bank and save it. It doesn't just sit in. Oh, sorry about that.
It's all right.
Let me turn down the ringer on my phone. Okay, it doesn't just sit in quote unquote non-useful, non-productive places, which is how government thinks of savings. They think of money you save as being non-productive because you're not putting it to work, which misses the whole point of savings, which is to give you a cushion against life's curveballs and to build capital to allow you to do productive things later. And governments don't get that. In the Keynesian economic framework, saving is bad because it slows the circulation of cash and it lowers the amount of stuff that we buy, preferably with borrowed money. So they don't like that. So they're very happy to ban cash. In fact, they would love to be able to ban cash. They've just never had the rationale to do it before. And now it's coming. And they also, in some places, are encouraging stores to refuse to take cash. You know, there are ways to do it. Or they can just flat out stop issuing cash and make it illegal after some point. So this is all possible. They can do it. But they're concerned about the ramifications of doing it, because does that create a black market in which regular people are turned into criminals because they don't turn in their cash and they keep it and they do things with it the government doesn't want them to do? You know, there's no way to know how all of this plays out, except to say that we're probably violating some basic laws of finance. And when you violate basic laws of the universe,
natural laws, yeah,
you wish wouldn't happen, and we are headed for that. It
reminds me of lots of other examples in, for example, ecology or whatever, where governments will get involved and they'll introduce a non-native species into a body of water, thinking, oh, that'll make better fishing opportunities, or they'll take actions. We're going to quit. We're going to start managing forest fires to the point where the natural cycles are disrupted, and then everything just gets bigger and worse later if you try to impose yourself into Mother Nature and take control of things based on ideology and policies rather than natural law. Can we circle back to something you touched on earlier when you were talking about the increased choppiness in the markets? One of the things that keeps happening is whenever Trump tweets or Mnuchin says, "Hey, think talks are going well with China," markets lurch up for a couple of days, and they say, "Oh no, looks like we're far from a trade talk with China." Oh, then the markets will drop for a couple of days. So these trade relations, how significant are trade wars that are taking shape and the tariffs that are being formed? What do you see happening there, and what are the impact going to be for the ordinary person?
Well, as stocks have been going up lately, I've been looking at starting a big shorting program. I wanted to bet against stocks at these prices, but I've been terrified by that announcement, like you said, that some 4 o'clock in the morning tweet says, "Yes, we got a trade deal," and everything's great from now on. I love China, and stocks rocket, and it feels like that's out there somewhere, because really this is negotiating, and it's extremely messy, as a good negotiating round usually is. Usually you got to get up and walk out of the room a few times, and you got to make some threats in the course of really enthusiastic a negotiation. And that's what's happening right now. But it's not in America's or China's interest to just let this go on and have this be the new reality, where we've got massive tariffs on each other's products and world trade is shrinking at a double-digit annual rate. That's not good for anybody. And it was never Trump's intention to arrive there and just stay there. He wants a deal. So I think at some point a deal will take place, and I think that'll calm the markets for a while. That's very possibly a 3,000 point on the Dow kind of announcement. But we can't know the timing. So in the meantime, see, Trump is I'm going to give him some credit and say this is all part of a strategy and a plan where he's got a kind of a rip-roaring economy right now with record high stock prices, which gives him a lot of ammo. In other words, he can take a hit to the stock market and it's still richly valued. He can take a temporary hit to the economy and we still have 4% unemployment. So he feels like he's got some leverage right now because he can take a few hits and maybe China can't quite as easily absorb those hits. Plus, there's a presidential election coming up in 2020 that the Republicans really want a strong economy and a placid international relations situation for. So it's in Trump's interest to drag this out for a while, take the pain now in order to get the best possible deal, announce the deal sometime in 2020, just in time to send his approval ratings up to their 4-year high, and then run for re-election. So the timing of this, from a political standpoint, implies that Trump sees himself as having 6 months and 5,000 points on the Dow to play with, which means it might get a lot messier before it resolves. So we should be prepared for the kind of volatility that would result from that, but also have our eye on what happens when that announcement comes out of the blue at 4 o'clock in the morning that they've settled everything, and the whole trade war thing is done, and now we can move on, with blue sky ahead of us, and that's out there too. So there's no guarantee that it plays out this way, but I think that Trump is envisioning a scenario that works this way in the best case. This is his ideal scenario, and he's taking steps to get closer to it. And maybe I'm giving him too much credit, but it does seem like this is actually part of a plan.
What I was going to ask you is, are you giving the economy too much credit? Because we've had various people on, from Gregor Mannarino, Rob Kirby, and others, talking about the statistics that were being given, like the unemployment rate, like the, as Andy Hoffman likes to call it, the Dow Jones propaganda average, and others that seem to indicate on the surface, at least the indicators that are being touted by the president himself or by the mainstream media as indicative of a robust economy. But on the other side, you've got, shadowstats.com and others saying that, and you've said in the past on here, that some of these statistics are flat out manipulated and telling us partial truths or twisted truths or untruths to create that narrative, to keep that narrative going that we've got a robust and booming economy. And in fact, you just pointed out a little while ago here that the Fed felt that they couldn't raise interest rates, which you would normally could do in a robust economy. So help us to reconcile, okay, just because Trump's got a propaganda machine running that says we're in a robust time, we can afford some of this. Will the actual ability of the economy survive some tough measures like a trade war?
Well, a couple of things. One is that you can borrow a bunch of money and make things seem artificially good for a while. That's what the government did the last couple of years. They did the big tax cut, where they effectively borrowed $1 trillion a year over the last 2 years and just gave it to us. So it's no surprise that people chose to spend some of that money. Home prices are up in most markets. And you see the labor force participation rate being way out of whack with super low unemployment. And I choose to interpret that as, one, half the 26-year-old white guys in the country are opioid addicts now, so they aren't really part of the labor market anymore. And two, a lot of boomers are retiring. So that skews the labor force participation rate. In other words, it puts a lot of people who might be of an age to work in a category where they're not working for whatever reason. And, as far as labor markets being tight or not tight or whatever, I kind of like the anecdotal stuff that's coming out now, where you see all these stories about companies that can't find workers, so they've stopped drug testing, or they're going to local high schools to hire 16 and 17-year-olds, or they're setting up booths at the local jail, catching guys just as they get released and hiring them. And just in today's Wall Street Journal, there was an article about the smallest category of companies that they track, or employers that they track, is now seeing employment growth slow to a multi-year record, not because they don't want more people, but because they can't find any more people Tiny little companies cannot compete with bigger companies in terms of perks and the various benefits and even wage levels that and so they can't get enough people to run their businesses. Now that doesn't imply 40 million people who wish they could work, who are disgusted and they're out of the workforce and who would gladly come back in. That just doesn't jive with the general interpretation of a really high out of the workforce stat. So I do think that the labor markets are tight now, and those aren't really isolated anecdotes. Look at type labor shortage or truckers or anything in a category of skilled labor. Anywhere where you've got to have some skills, but it's not international lawyer or investment banker or something like that. They can't find people. There aren't enough people to do the jobs. And if you look at wage inflation right now, wages are starting to go up. They're not rocketing, but the past year's growth in wages was about 3%, which is above the Fed's target inflation rate. So some or all of these numbers from the government could be false. But I think the stories, the anecdotal stories about companies not being able to find people are a lot harder to falsify because they come from so many different sources and they all kind of say the same thing. So we shouldn't be a surprise 10 years into an expansion. Every single expansion that we've ever seen has had labor shortages at the peak. Usually it's after 6 years, though. So this time took much, much longer to happen. And it required a gigantic tax cut right at the end of the cycle when you don't normally get gigantic tax cuts. And it required negative interest rates in a big part of the world and still historically low interest rates in the US. But it seems to have happened. And, it's about time because workers deserve higher wages. So this is a really good thing, except from the point of view of the Fed, who sees it as inflation that they understand. When stocks and bonds go up, Fed doesn't see that as inflation, or houses. They don't count that as a part of the cost of living. So we can have these monster inflations in the financial markets and have the CPI show up as 1.7% annual rate. When if we included stocks, bonds, and real estate in that index, it would be 3 or 4 or 5% annual rate. We'd have aggressive inflation now, which is part of what John Williams at Shadow Stats is saying. He said, if you calculate it honestly, it's much higher than the government tells you that it is. But all of those lies being what they are, that still doesn't mean we can't have tight labor markets. And we do seem to have them in at least a lot of sectors, if not in every sector. And that gives Trump some leeway. It allows him to do things that maybe get some people laid off. But if the industries or if the people that got laid off can go right down the street and get another job, then it really didn't hurt them that much. And it doesn't necessarily cost Trump that many votes. So it allows him to take a few months to force China into a more advantageous position for us. And by the way, I'm not a Trump fan as a human being. Donald Trump never struck me as a good person. He's never been somebody I wanted to praise. But he's turning into a consequential president because he's already nominated 2 conservatives of the Supreme Court. He might get a 3rd before his term is over. And he's forcing China, or at least trying to force China, to stop cheating in global trade. And they do cheat. We should have better terms of trade with them, where they don't just send out an army of hackers to steal our industrial secrets or our military secrets, and where they don't force companies who want to do business in China to turn over all their international intellectual property for the privilege of being able to sell to 1 billion people in China. That's unfair. And to the extent that he's trying to rectify that, good for him. It's the right thing to try. And it's got some timing on its side, as I was saying. He's got some leeway, and he doesn't need to get this done until a few months before the next election. So he's in a pretty good position right now, which means the stock market may not be in a very good position right now, because that's one of the casualties. That's one of the things Trump might sacrifice in order to get that deal done. And if that's the case, then I really should have shorted the hell out of this market 3 weeks ago, like I was thinking about doing, because there are air pockets under these stocks. A lot of tech stocks could drop by 50% and still be fairly valued and still be great companies, but just be 50% cheaper.
And some of our other guests, such as John Adams from Australia, have weighed in that they see, as we see choppiness at the top of the stock market, they're seeing choppiness and rolling over of the real estate market, for example, in Australia as well. So some of those multiple indicators are showing potential victim status going forward. So it'll be a very interesting year as this plays out, and a lot of people on our channel, watching our channel, are concerned about not wanting to join the ranks of those that are caught unawares in the herd, and they're wanting to find ways to reduce risk to themselves. A few tips from you in as far as people wanting things that they should look into if they want to reduce their exposure to these types of volatility going forward.
Yeah, well, one thing you can do is embrace the volatility. There's a thing you can do with options called a volatility spread, where you buy a put and a call on a given instrument. The put goes up if the stock market or that thing goes down. The call goes up if that thing goes up. And your goal there is for that thing to go either way up or way down, or both way up and way down. And you make money on the moves of each instrument that exceeds what you had to pay to put that spread on. Okay, so that's how you directly play volatility. A second thing is assume that the central banks of the world will aggressively lean against any hint of a downturn. In other words, if we get a 20% drop in stock prices, the Fed's going to cut interest rates. And probably the Bank of Japan and the European Central Bank and the Bank of China will all jump in and do the same thing. Now, that kind of thing is historically pretty good for gold and silver. If you look at 2008, the financial markets just tanked, and gold and silver went down along with stocks. But then the central banks jumped in and instituted QE and super low interest rates, et cetera, and gold and silver took off. And they had one of the best runs in precious metals history because they had the central banks at their back. We could see a replay of that again. History doesn't repeat perfectly, as the old saying goes, it rhymes. But something similar could happen again if the central banks just preemptively get in there and start cutting and start buying up assets with newly created currency. Some of the money that they're spewing out will flow into precious metals, which are tiny little markets compared to the amount of money that's being created by central banks. So it wouldn't take much to push gold up to a couple $1,000s an ounce and silver back up to 50. That could happen very easily. Worst case scenario with precious metals is that they protect your purchasing power over long periods of time. So 20 years from now, whatever gold and silver you buy now will buy the same amount of stuff as it does now. And that's not bad as a worst case scenario. So precious metals are a good thing to be looking at now. Real assets in general, at a time when governments are actively trying to inflate away the currency, which is what they have to do to get out from under this debt, real assets tend to do better than financial assets. So high quality energy assets, oil wells and solar farms, things like that ought to do pretty well, and farmland ought to do pretty well. And a really well-chosen real estate, like rental properties in a college town that has a stable economy, ought to do well. But don't think that all real estate is created equal. Mm-hmm. San Francisco condo will not do well in this kind of an environment because it's already quadrupled in the last 5 years. You just don't want to be in something that's in bubble territory. But something that has positive cash flow and is relatively low maintenance and in a stable market, that's a good place to hide out. And just, it's in general a good investment, that kind of real estate. And it's especially good when the rest of the world is going crazy. So stuff like that is probably in the category of things that will do well in the kind of tempestuous, maybe chaotic markets that we have coming.
On that note, John, if people want to find out and follow more of your writing and your articles, where can they keep up to date?
I run dollarcollapse.com, which basically talks about all of this stuff, updated continuously. So go there. You'll see whatever is happening in the world of the dark side of the financial world.
We've been speaking with John Rubino, founder of DollarCollapse.com. John, thanks again for joining us on Reluctant Preppers.
Thanks, Dunnigan.
Hey, Reluctant Preppers. If you haven't heard, we've already started our monthly 1-ounce U.S. Silver Eagle thank you gift to one active Patreon subscriber each month, signed by your host, Dunnigan Kaiser. And you don't want to miss out on that.
Please help us grow by subscribing today at patreon.com/reluctantpreppers.